All right. Good morning, everyone. Welcome back to another episode of the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. This week, we're talking about how underwriting is not the same depending on your perspective. Whether you're a lender, you're a buyer, you're a broker, or if you're a seller. Tim, I just thought about that one on the fly. We didn't really talk about that. Each group is going to look at the numbers differently and have different perspective. And we recently closed the refinance of a $5 million loan on Friday. And boy, did we learn some lessons. And let me tell you something. It is one thing to learn a lesson. It's another thing to not do anything with that information. And God is my witness. We're talking about some more refinances that have to get paid off by 5/1, and I'm already challenging lending brokers on their assumptions and their underwriting because I said I cannot be in this situation again where we got proceeds cut substantially from what our original expectations were because of almost I don't bait and switch is a bad word, but that's the best explanation I can come up with of, hey, I'm going to get you the most proceeds that you want to see on paper. And then we're going to get you all the way down the road. We're going to get you appraisals and we're going to send you, send deposits. And, we're 60 days down the road at 45 days down the road at this point. And then I'm going to tell you, hey, sorry, we're going to cut your proceeds by $1 million. What do you do at that point? You're so pregnant at that point that you can't do anything about it.
Yeah, and you're doing the right things. I mean, because guys, to be honest, like over 2 years, Tim, this has happened at least 3 times with 2 different
Shame on me,
brokers.
huh?
Well, but yeah, I mean, but the first time it happened, just so you guys know, the first time it happened, the valuation came out, and Tim and I were both like, I don't know about this. Like, I don't know. And the broker's like, no, like this is good. This is good. Right. This is solid. You're going to be close to this. And we weren't, like, big swings. So we go to a different broker. The 2 we did last year.
Okay.
Yeah. And then, so we're like, yeah, that broker, right. And then we go to another one and same shit happens. Right. And at some point, Tim and I look at each other and go, okay, we got to be asking different questions.
Yeah.
Right. And to Tim's point, he's doing it. Like he's on it. He's asking those questions.
Yeah. I mean, this is a smaller deal that we're looking to refi.
Yeah.
And generally, like, I guess this kind of leans into like why we're actually doing the show. And Brandon, I'll follow up with you on that. This actually lends into like why we're doing this, right? Because I know Invest knows, and a lot of investors know what common bank assumptions are. There's a big red flag when you have a lending broker that's not underwriting to what common lender expectations are, even on small deals. On larger deals, there's a lot more leeway, but on small deals, it's pretty cut and dry. It doesn't matter what your actuals are or what your pro forma is expected to be. It's a standard, right? And I started pushing back on that, and they're like, well, then it's going to cut your proceeds. I was like, on paper, but what are we actually going to get when the lender sees it and says, no, we're definitely going to underwrite to this percentage instead of that one?
Yeah. So yeah, and it's a couple of things, right? Like Brandon, I mean, not to give too much away, but Brandon, thank you for that. And there's a little bit about your response that makes me go, but it has nothing to do with you. Let's just say that.
Yeah.
But at the end of the day, Tim's not wrong. Like some of it is like asking those questions, but then too, it's also making sure that broker, like if you're dealing with a broker, making sure that broker knows how to defend or look at something accurately, right? Because Tim challenged me on this, but in my opinion, or from what I think we've seen, once the lender decides that it's worth this, it's really hard to go back and challenge it and get them back to here. Like maybe they, if this is the gap, maybe you get here, but you're not getting all the way back to here. So
no,
you got to make sure that broker is able to be organized and up to speed enough that they can go like intelligently have those discussions early. Because man, we've been there where the broker has missed some things, and Tim, to his credit, has come back and said, no, this, and we get a little bit of room for it, but we never get the total credit for
it. Your one line I actually told him literally yesterday was, let's under promise and over deliver instead of the other way around.
Exactly.
Because I'm tired of having being really excited about something and saying like, yes, this is finally working. My God, Tim, you remember it? So just so you guys know, 213 days to close this refinance. 213, 3 times as long as Brandon Vergalito's 75-day period. 3 times as long. And let me tell you, I was so excited about this. I was like, yes, like it's working. Like, we did everything right. We're, finally there's a light at the end of the tunnel. We're going to refinance. We're going to do what we said we are going to do. And then, from original soft quote to first round hard quote, $1 million in proceeds gone. And then we went back, then it was under, then we went back and fought and we got it back up. And then we finally got it to a good place where it was going to be cash neutral refinance. And then from rate lock, which is literally overnight, from final commitment to rate lock, another almost $100,000 gone. And I was like, what was all of this for? Like, poof, just $100,000 gone, and it was like, oh my God, this, whoo, dog.
Yeah. Sorry, man. You have you ever seen the
painful.
movies? You ever seen the movie Zero Dark 30?
I have, yeah.
Your 213 days reminds me of when Jessica Chastain's like drawing on her boss's window. Like she's trying to get him to act on information she gave him. She's like 200 days.
That's a good reference. I haven't seen the movie in a while. Maybe I got to do a refresher on that one. But you just need Ohio people. They work harder. We have nothing better to do. As we're sitting here with like, I don't know, Vest got like 12 inches of snow right now, and I got 3, which is wild for Wilmington, North Carolina, that we got 3 inches of snow.
Hey, Brandon, I thought it was funny. I saw a post the other day. It was like this guy standing on the coast in Italy, and I guess he's Italian, and it's from where his ancestors were from. And he's like, somewhere my great grandfather looked out on this view over the ocean and said, I'm going to move to Ohio.
Yes, Dennis, I think that is an accurate explanation.
You feeling a little throat punchy?
Yeah. So,
all
right. Yeah. So let's. I want, now that the little vent sesh is over, I do want to get into a couple different things of like, the difference between buyer underwriting, broker underwriting, lender underwriting, and obviously we kind of skipped ahead and we talked about some of the refinance lessons that we learned earlier. But on the underwriting side, when you're a buyer, what's that saying, Tim? I'm going to butcher it. It's like every buyer's a cheapskate and every seller's a crook or something like that.
I think that's great.
Works. So like every buyer is going to underwrite to, expenses way, maybe not way higher, but like, you have to make assumptions because you don't really know what you're getting until you own it. So you have to make assumptions on what it's going to cost you to own and operate a deal, and use the information that the seller's giving you as like kind of a backstop or like a point of reference of what it could do. But it's not saying that's what it will do. It's what it could do. And that's only if you have the operational efficiency, resources, and relationships in that market to be able to operate a property at that expense load, right? So buyers are always going to pad the expenses a little bit to give you a little bit of cushion. If you're running 100% occupied, I'm never going to underwrite my property at 100% occupied. I'm always going to take, depending on the size of the property, anywhere between 5 and 10% of vacancy off the top, because it's just part of the business. Like you just get people that don't pay the rent, that fall in hard times, yada, yada, et cetera, and so forth. So buyers, they focus on downside protection, right? We're stress testing the NOI. We're stress testing expenses, testing exit cap rates, which, we do. We follow all those rules of thumb, decompressing the cap rate 10 basis points per year that you own it. But what we saw over the last 2 months was 50 to 100 point decompression in 24 months, right? So not only, you had insurance costs double, you had property tax reassessment values go up significantly, utility usage rates doubled, for like water, sewer, electric, all those usage rates went up significantly. Combined with softening rent markets, combined with higher delinquency and vacancy because of oversupply in the market, so less demand for your properties. And then you get hit with a 50 or 100 basis point, or 0.5% to 1% decompression in your cap rate. It is a recipe for disaster. And I just want to say again, I'm thankful that we were able to refinance out that expiring bridge loan and get into a 5-year long-term loan because now we have time to ride out the
Yeah.
rest of whatever this is.
Yeah.
But us being able to trade out the debt, even with a 140-ish thousand dollar cash in refi, is not the end of the world. Like obviously it is not what we wanted, not nor what we had expected to happen, but it is a positive outcome of being able to protect the asset, protect the investors, and live to see another day, right? Because now we have the opportunity to get to 2031. And when 2030 rolls around, which is when I think the commercial real estate market will do a significant kind of turnaround, we can make the decision, hey, we're going to refinance this again, or are we going to sell it, right? And having options in that point is good. We don't have this looming expiring debt anymore, which I mean, the stress of that is, my goodness. I mean, we lowered our rate from 10 and a quarter to 5.78%. Unfortunately, no interest only on this loan. Is 30-year amortizing from day one, but our payment went from $41,000 a month down to $29,000 a month. So, that gives a significant amount of breathing room for operational expenses, to do maintenance on the property, additional maintenance on the property, build reserve balances, pay distributions to investors. I mean, $30,000 a quarter is not a significant amount of cash, but it's something, and it's better than what it was comparatively to when we were
Oh,
paying 10 and
yeah.
a quarter percent interest.
Yeah, for sure.
Now we have time on our hands. We have a lot of our, we did our property tax abatement, so our taxes are mostly fixed now. We're starting to see insurance costs come down. Last year we saw a 30% price reduction. We've had a lot less turnover, more stability, better collections. Now we have the time to wait for rents to continue to go back up. And I'm hopeful in the next year or two they do. And I mean, we're talking an 88 unit property, rents go up 25, $30 on, you're better at math in your head than $30 on 88 units. That's $2,600 a month times 12. And it's extra $30,000 in cash flow by going up on the rents $30 a month, right?
Yep.
And you start to get that time component of compounding and compounding and compounding. Right. We did all the hard work. We did all of the risky work of the renovations, the quick turnover, the value add by getting the rents from $600 up to $900. Like we did all that brain damage. Now it's okay. Let's sit on it. Let it stabilize. Let it continue to build a better reputation for itself than what it used to have in the past. Continue to be super tight on our tenant selection plans and our criteria, and just continue to involve that property because it's worth it, right? And you start to see
Yeah.
those benefits in the long run.
Yeah, but kind of getting back to what we were talking about, I think that's a good segue into, Tim, like what's one of you do a lot of underwriting. What's one of the places that you see where, I don't know, sellers or tend to be off with their numbers, like their expectations versus, what you see as a reality?
There's a couple places. Sellers never take into account the buyer's new taxes, right?
Yeah.
The properties are good. They're going to reassess. You have a taxable event. My property taxes are going to go up. Therefore, immediately value goes down as soon as you buy it because of the tax. So you have
Yeah.
to negotiate down for that. The other side of the coin is the biggest one that I get all the time is, well, I just got this insurance renewal. Why won't your insurance be the same price per unit? And one of the basic principles of an insurance policy is that you need to have enough coverage to cover the loan amount. By default, if the seller is selling it and you're buying it, they're generally selling it for a profit, and your loan amount is going to go up compared
Right.
to what he had. So therefore, you will have more insurance coverage because the higher purchase price, higher replacement cost, higher loan value, and your insurance costs are going to go up. Um, right there, absolutely. Some of the places that we see are fixed, right? Utilities, payroll, those don't really change a whole lot. Management fees, subjective to, are you using third party manager, or, are you going to manage it yourself? And then repairs and maintenance.
Oh,
We buy from a lot of mom and pop owners, and well, I've been cutting the lawn myself, so there I expect you to cut the lawn yourself. No investor is going to buy a property and expect to cut the lawn every other week.
yeah, not many for sure. And speaking of that, and I think you hit on one a little bit earlier, is like when a value add deal transitions to a stabilized deal, right?
Yeah.
You a lot of R&M during the value add phase tends to end up in capex, which
Oh,
is
absolutely does.
yeah, which is below the line, right? So,
Mhm.
as you move into a stabilized asset, more you're going to see more and more on that R&M line as opposed to below the line in capex. Um,
Mhm.
and it and I think a lot of buyers and sellers kind of, I don't know, lost sight of that, right?
Mhm.
Um, Tim and I just before this were talking about one that I've seen where there's significant amount of capex below the line. The R&M number is just not reasonable at all, and it's because it's in that value add stage, right? Um,
Mhm. Yeah.
and it just but that really inflates the value. Some 2, 3, 4 million bucks may be what the seller's like. No, based on my T12, here's the value. It's like, no, I don't think that's right. Um, so that you got to watch out for that kind of thing. And then Tim, like one of the things that I thought was very interesting about your insurance, and an extreme example of that, Tim and I were buying for a little while from an investor who would do a lot of deals in cash, right? Um, so his insurance requirements were way different than what we would have to do with a lender involved.
Mhm.
So but his underwriting would take into account his in what he was paying for insurance, and it's like I can't hit that number.
Right.
uh, you
Right.
know,
Yeah, that though the insurance and taxes are definitely the
yeah,
big ones. And that's one thing. That's why, like, if you're looking at a property as a buyer, the general assumption is $750 to $1,000 per unit per year.
yeah,
If your current ownership is not spending that much, it's it's not unreasonable to underwrite to that same standard. I
yeah,
mean, when it kind of brokers will do that too, right? So like when I was selling a property outside of Florence, I mean, my actual cost for R&M was like 450 to $500 per unit, which is on the low side for sure. But when the broker was pitching the deal on the sales side, he underwrote it on a pro forma basis to $750 per unit. And I was like, but
mhm,
that's not fair because it doesn't cost that much to run this property. And he was like,
yeah,
but any buyer or any bank is going to look at this deal and say, even though you're not spending it, we're still going to estimate that that's what it should cost. And
right,
in our coaching group, I talk about it all the time of normalizing your underwriting expenses. Because that's kind of where I see a lot of people fail is that they don't they don't normalize the underwriting expenses. They underwrite it for what is currently doing or what they think it can actually do. But then when you get to appraisal or you get to refinance, or any kind of bank assumptions, you might have overvalued your property because you didn't include the correct amount of expenses or normalized expenses, right? So like, what's an example of that? If you have a if you have I don't know, like a 25 unit property and you self manage it, you can charge it 3% management fee, right? So your NOI will be higher,
mhm,
and you might get proceeds on a refinance, but you're not going to get that on a sale because anybody else is going to say, I can't run it for 3% management fee. I'm going to have to pay 8 to 10% management
yeah,
fee. So what is my NOI now? And is it going to be adjusted to so that the expenses are normalized for what everybody else or what you can consider the market will be able to operate a deal at, right? And that's kind of one of the things, we were talking about it before was even on the lender side is, you have to look at their lending assumptions and what they're underwriting to and challenge them on some of their assumptions because just because that's your structure doesn't mean that's the way the lender's going to look at it, right? And if they do, great, but let's not set an expectation that they're going to change the management fee to whatever I can actually do it to
yeah,
versus what the market's going to dictate. Because always remember that a lender's perspective is going to be, what is it going to look like if the bank, have to take it over?
right,
And they are always going to have far higher operating expenses than you do.
right. Well, they're gonna higher operating expenses, and they're also not gonna be like challenging the market on rent levels either. They're gonna be like, no,
Right? They're going to keep it
yeah,
full.
yeah, this is the rent. Um, So, hey, one of the ones that I I thought is really good, right? Is this the idea of future value, right? And you're kind of hitting on that now,
Oh,
because
pro
because
forma.
yeah, because I think that's probably one of the biggest gaps that I still see with deals on the market right now. that I thought, I fully admit I was wrong here, that I thought would really start to dial itself back in the last couple of years. And it doesn't seem to be dialing back, right? Guys seem to be like, no, here's what you can do. So this is what I want. Um, Now, that being said, Tim, you told me about one in your area that sold for a crazy cap rate.
Yeah,
Um,
2% going in cap rate for a stabilized 5 cap. Put it under contract in 3 days. What?
yeah, and yeah, and I guess I get the market to some extent, and maybe that's a 1031 buyer that's like, man, I just want to sit for 15 years. I don't care, whatever.
Mhm.
Maybe, but I mean, at the end of the day, it's like this idea that somebody is going to pay you for future value just I still doesn't really make sense to me right now. Um,
Well, I think challenge me here. I think you and I were talking about this, or maybe it was with a different broker or something on the phone. But ultimately, where sellers are now is because the market was so hot in 2020, 21, and 22, there's been a benchmark set of what the property could do and what
mm,
it could be valued at. And there's an expectation of being able to sell it for, well, hey, this thing traded 3 years ago at $200,000 a door. If you buy it today for 170, you're getting a good deal.
I guess. I mean, I guess. I mean,
I'm sorry, I'm not buying it.
yeah. I mean, I guess I can see. I guess I can see the mindset, but I guess the hard part is like, okay, tell me when it's going to hit 200 a door again. Tell me
Yeah,
when. Tell me when, so I can underwrite that and I can figure that out.
right,
Um, I I don't know. I mean,
right.
and guys, there is a world, right? There is a world where you're like, hey, 200,000 2 years ago was I mean, that maybe that was a 10-year premium, right? Where you look at it and you go, I don't think we hit that for 10 years, right? I
Maybe.
don't, I don't think
Hard to
that's
say. Nobody
unreasonable,
knows what's
right?
going to happen
Right.
with rents and expenses and, property. What's the next black swan event that nobody's foreseeing?
Yeah. And because I mean, at the end of the day, it's like you can't tell me that's impossible, right? I mean, we all agree real estate appreciates over time. Yeah, but nobody agrees on how much. Um,
Yeah, right. By how much?
right.
And even if it does go up 3% per year, you take into some of the things we were talking about earlier about reassess tax value,
Right.
increase insurance costs, and just knock it back down in value essentially. And that's why a lot of our underwriting has changed. And we are, dude, I'm telling you guys, we are striking out across the board when it comes to making offers on deals because we are adamant about 125 in place stabilized debt coverage ratio on my purchase.
Yeah.
And that, hey, it's like we took that from a broker and we said, hey, if I can get 70, 75% leverage, I got to bring 25, 30% down. My money's got to make 7% from day one. This is what my purchase price could be. And we're striking out. Nobody wants to transact there. And I'm just not buying until we can get something that is cash flowing day one because that's what you have to focus on. Paramountly, you have to focus on cash flow. And yes, value add has its place, right? If it is something you are absolutely sure about, but with how things have gone over the last 2 years and property values coming down as much as they have, all the value add guys, ourselves included, are feeling the pain. And like I said, thankful that we're able to refinance and get trade out the debt and do what we got to do. Where we can live to see another day on that property and ride out to hopefully the upswing of this market again.
Yeah.
But if we had focused on day one in place cash flow, we would have paid significantly less for that property. And then we would have refinanced it on Friday at the value that it traded at and been hopefully able to cash out refinance.
Yeah. I think we're maybe answering our own question here a little bit, right? Like, use that 200 and 170 example. It's like, hey, I can pay you 150, but I need 170 because I paid 200, but it cash flows at 150.
Right.
I'm sorry.
Right.
I'm sorry you overpaid by way too much 2 years ago.
And but I mean that's I've definitely gotten some more thick skin because it's so funny when you're on the sell side, a broker will tell you that all day long. It's got to underwrite to 7% cash flow on their money day one.
Yeah. Yeah.
Right. Or even at maybe by the end of day one, end of year one, if there's a strong value add play, right?
Right.
and significant upside on the deal. On the sell side, a broker will beat you down on expectations to try to, get, almost fighting for the buyer at that point. But when you're on the buy side, no, the conversation with the broker flips. Oh, you got to underwrite the value add, but in 2 years it's going to be doing this. I'm like, okay, but it doesn't pay its debt today, so therefore now you have a liability instead of an asset.
Yeah. Yeah. I could not agree more, man. So what
I
else?
really hope that something changes here in the next 12 months. I mean, I'm really itching to buy another deal here in 2026 because it has been
Yeah.
since September 2024 since we closed on our last deal. I mean, we've been doing a lot of refinances, which is its own level of brain damage, but we haven't acquired anything new since then.
Yeah.
And I'm really itching to get something, with this kind of new perspective and mindset, and and just going after different types of, I don't want to say different types of asset classes because we're still going after multifamily. We still like LIHTC, but we're looking at more newer product, more stabilized
Yeah.
properties, more consistent cash flow, buying it on a 5-year loan, agency 5-year loan immediately day one. The short term bridge lenders like are super difficult to execute on the business plan. And I'm not saying that I won't do one of those. I just got to really know, like, if somebody
Right.
came to me with a deal in Charlotte for $70,000 a door, done, buy it.
Right.
I don't even have to think about that. But if you're saying, well, maybe you could do a bridge loan at $100,000 a door, sorry, it's too thin. With values where they are now, with holding costs, with carrying costs, with renovation costs, turnover costs. I mean, it just adds up so much, and you got to fund it all from equity. I mean, it's all gone.
Yeah. But Tim, rents in Charlotte are softening.
That too. I mean, maybe for for right now, the perspective on all of our
Right.
Charlotte properties is just renew people for what they're at. Just don't make anybody leave. Just keep it full. you
Yeah.
know.
Yeah. Yeah. Yep. Um, I got nothing else to add to that. I think it's great. I, I mean, guys, we could sit here and talk all day about expectations versus realities.
Yeah, Harish says
Uh,
lots of properties in distress now, especially in Sunbelt areas. And you know what I will tell you? It is in major metros. They had a bigger swing in demand, right? You had cap rates in Charlotte, Raleigh,
yep.
Columbia, Charleston, Atlanta, major metros in the Sun Belt, or well, Southeast. Sun Belt obviously goes across the whole state, but the Southeast Sun Belt where we focus on the properties that were more stable were those tertiary markets that didn't have a significant uptick in demand, but also didn't have a significant downtick with the change in the market, right? So, like Greenwood has been pretty stable. I
Yep.
mean, we saw some cap rate decompression. Florence and Darlington were good markets that kind of were stable. Southern Pines was pretty stable. The outskirts of Raleigh has been very stable.
Yep.
Um, a lot of the South Carolina properties they moved a little bit more like, the coastal properties. Those ones had a bit more in, increased insurance expense,
Yeah.
with hurricane exposures and stuff. But the cap rates really hadn't changed a whole lot on those.
Yeah.
That was just really a change in operating expenses.
Yeah. The one thing I would say, and I won't mention names because there's a particular investor out there who's pitching certain markets, and Harish, they actually use that thought process right there as a reason, like you shouldn't invest in the Sun Belt. And where I always come back to that is, don't let someone's mistake from 2 years ago make you overlook the basic fundamentals in markets that make them good markets, right?
Hmm.
And the fact of the matter is, the Sun Belt, and then specifically the Carolinas, a lot of places in the Southeast, if you look at the population influx, those fundamentals are still there. So don't let the fact that somebody paid 200 a door in Charlotte 2 years dissuade you from buying in Charlotte, right?
Hmm.
That's not a reason not to buy. It's just a reason not to pay 200 a door.
Yes, right.
So
But that's why I'm still bullish on
yeah,
in the Carolinas. Like, sure, we're
100%.
going through a difficult turn right now because there's an oversupply. But I saw some reports come out. I don't know, maybe I forwarded it to you or not, but I saw some reports come out about how there was like now historical low amount of deliveries of new construction.
Yep. So
And it's like, okay, so give it another 24 months, you let all of that absorb, and then you don't have any significant new starts, that are going to start delivering until 2029, 2030,
yeah,
and you start to see that curve come back.
yeah. But to your point, Tim, those secondary and tertiary markets, lot of good value there because literally last night, and I'm not going to mention the market, guys, sorry, but it's a little gem. Literally last night, a market just outside Charlotte, there's no supply in that market. So renters are being forced to come back into the Charlotte area to find rents, right? And they're paying more than they want to pay because they got to come back in because the area where they want to live doesn't have anything. And it's like, yeah, there's demand in that market. There's more demand in that particular market just outside Charlotte. There is supply. And that's a good market to buy it. And so Tim's offering some good insights here with like, hey, look at those secondary and tertiary markets. And, at the end of the day, if I never buy in Charlotte again, it won't kill me. I'd love to buy in the city proper. But, I can buy around Charlotte and do quite well.
Oh, absolutely. Yeah, I agree with that. So, all right, guys, that's all the time we got for today. Appreciate you joining. Hopefully you learned from some of our experiences. And, every week we come on here, we talk about wins, losses, lessons learned, how we're implementing the things that we've learned so that we don't make the same mistakes again, and hopefully passing that knowledge to you so that you also don't make those same mistakes. So appreciate everybody joining the call, and we will see you again next week. Peace.
See you guys.